We're coming to you from the JPMorgan conference right here in Mumbai, and who better than Sanjay Mookim himself to kickstart the discussion on these very hectic 2 days up ahead.
Thank you for having me, Aisha.
Thank you for having us. So what's the agenda? A lot of news flow and a lot of debate, I guess. What a time to have this conference.
It is, and I was a bit hesitant to begin with because the market's been lackluster. Let's say it's been flat for a year. But it's a massive vote of confidence. This is the largest ever conference we've organized. Over 1,300 delegates joining us. The number of clients joining us is up more than 30% YOY. We have a greater number of corporates. The buzz is really strong. And like I said, that's a big vote of confidence. Investors saying that, look, we don't care about daily volatility, all this noise that you're referring to. But India does present that long-term opportunity, and people's interests are a little bit more permanent that noise might otherwise entail.
Good to hear that there is still excitement about India. But it's kind of a juxtaposed because on one hand you still have uncertainty on tariffs. Over the weekend you had all that H1B news coming out, and then from today onwards GST 2.0, one of the biggest reforms in the last few years, again kicks off. So what are investors really feeling about India right now?
Well, if I roll this back to a few months, call it late March to June period, there was a sense of despondence in conversations that we were having with investors. Oh, nothing's happening, and it's all looking very gloomy. And the corporate sector was sort of echoing that as well. That has improved to my mind. And the setup for a bounce in Indian equities looks very, very strong to me. I'll walk through a few reasons for this. Our earnings expectations have already been cut, quite a bit actually. Typically, earnings are cut in the later part of the fiscal year, but we've done it ahead of time this year because of that sense of despondence that I was talking about. On valuations, stuff looks very expensive on an absolute basis, but relative to global equities, we are now at a better position. So we've written research on this many times. The India valuations tend to track S&P more than they track EM. Okay, historically the charts are the same. The S&P, PE and ours is the same. Now we are at like a 10% discount to the S&P. So you've got right-sized earnings expectations. You're trading at a discount to global equity valuations. And you have potential domestic catalysts, which is the GST you referred to. Now you may not get a great September quarter out of it because people held up purchases in anticipation. But the December quarter could turn out to be better. So with that, a little bit of a bounce in the market does look like a reasonable probability to us now.
What are the kind of questions that investors are now asking you in that sense? You spoke about earnings, because we went for a early earnings cut. Normally it happens in second half, but now I think most of the street is now looking at FY27 earnings and not 26, because they were almost written off FY26 in that sense. So what are they looking at in terms of valuation? When you're telling us that we are mapping ourselves to S&P 500 price to earnings, and we are at a discount to that. So how are we looking at, and how are global funds looking into it?
First, as a word of caution, we should not dismiss FY26. Quantitative correlations suggest that stock prices respond to 12-month forward EPS, not, let's say, the next fiscal. But 12-month forward still relies on some outcome in FY26. There's still 6 months to go, really, right? So quantitatively, the FY26 number still matters. And in another sense, if you cut your FY26 further, you will be forced to cut FY27 as well, right? Because people tend to track these in terms of growth basis. So I do think that the FY26 outcome is still relevant to stock performance. I personally wouldn't, ignore them and look forward. So if I am now able to meet or even beat the FY26 numbers, that will be a vote of confidence in my corporate earnings outlook. But to your earlier question on what people are asking about, predominantly it is what or which sector can have proper response to price cuts, right? Because you've seen the initial reaction to stock prices. Several sectors have already gone up. What next? Some sectors do I still chase? Where do I get real world impact on volumes for companies, or what's the elasticity really to price cuts for my companies? And that's the discussion, that's the groundwork everybody's trying to do, to stay on top of your channel checks, to stay on top of these micro trends in the industry, to see which sectors stroke companies will now really start to deliver better outcomes.
So where is that room for expansion in terms of volumes? Because if you just go by what the market is doing right now, it seems like everyone's just going to make a dash to two-wheelers.
Well, the discretionary, as a broader sort of category, does intuitively have greater elasticity to price cuts, right? More than, let's say, staples, and probably far more than commodities. And I agree with you, the market is also reasonably rational. Now, whether it is two-wheelers, whether it is entry-level cars, that's the debate we will have now. But a discretionary cohort is conceptually more, let's say, or stands to gain more from the price cuts that we expect will happen.
How is the foreign investors now looking at? They expected a correction in the valuation to come back into the market, and that's not coming.
The relative valuations have gotten better. That's the point I was making. Because global equities have gone up, our valuations do not look as bad as they did. And more important is if we now split it into sectors, right? Let's take the financials cohort. Our banks, even in a slowing economy, will still deliver a certain degree of earnings growth with a high degree of confidence for the next 3 years. But look at what's happened to global financial multiples. All global banks have been on a secular rally this year. And if you look at India financials premium to global financials, it's actually come off quite a bit, right? So in contrast to what's happening in the rest of the world, our valuations do not look as prohibitive as they were, let's say, early 2024.
But will that lead to money coming in?
Again, it needs a spark, I would argue. So now when you have rest of EM, rest of Asia doing so well, and people are engaged more in looking for opportunities in markets which have momentum at the moment, there is no real impulse immediately. So the first precondition would be for the rest of EM or rest of Asia to lose some momentum before the focus shifts back to India.
We've seen momentum going into China, Taiwan, Vietnam, and
Korea.
And Korea. But is there going to be reversal from those countries to come back to India?
I wish I could be so precise, to be honest. I wouldn't be sitting here.
My question is also with respect to tech, and that's a theme which has come over the weekend. The tech has been slow since last September. Discretionary spends falling off. Then Trump coming in, tariff wars. Multiple headwinds for this sector, and the final one coming in with the visa. How do you see the tech sector as a whole?
I think the development of the weekend is still evolving, and we'll figure out exactly the details of it and B, how companies respond to it. Maybe some onshoring is possible, but like I said, we do not have enough information here to take a very hard view on this outcome. But let me make a slightly broader comment. See, what's happening globally is that the whole trade structure, the integrated supply chain, is now being dismantled to a degree. Countries that relied on export or that trade will lose drivers of growth, and growth globally will become more scarce over the next few years, right? India is a country which actually has endogenous growth drivers. Even though my growth will likely slow because my linkage to the world is not zero, I still have exports, and those exports will likely come under pressure. But I am not entirely reliant on it. I still have a lot of very strong domestic growth drivers. So the alpha on growth in India structurally for the next 3 years will actually improve, because countries which are more dependent on exports will actually run out of steam faster. So on a relative basis, India will be one of the few large economies which will still have some visible growth over the next 3 years.
So as an investor, if you were to make a portfolio fresh based on this premise about, the domestic story being so strong on India and lesser reliance on export-oriented economies, what should be my biggest sector, overweights and underweights?
So let me answer that question two ways, right? If you're a 3 to 5 year investor, you look for compounding growth, right?
Sure.
The growth expectations will need to be watered down a little bit, right? One, because the economy itself is a little bit slower. Just take the stark contrast in nominal GDP growth. It was north of 20% FY23. It's now probably going to be 8%. And there isn't a view that this 8 is going to 12 in a rush. It probably goes to 9 or 10 over the next 3 years. But we are in a more subdued economic growth activity, which will therefore dampen the earnings growth and therefore possibly equity returns. The other argument we make is that shorter term returns are made on earnings surprises, not growth. We've done a lot of quant work on this. And if you're an investor for 12 months or less, you are looking for companies that are going to beat expectations of growth. Right now, that appears difficult as well, because yes, things have gotten right sized on the forecast, but do I have enough momentum for a large set of companies to surprise me on earnings? I don't see that yet. So my suggestion is, it is still a better asset to own in the India context, especially given the tax structure that we have locally. But do not expect a high double-digit compounding return from an India equity portfolio over the next 3 years. If I make 9% in equities in an index ETF, I should be happy with it. It's a good return.
And what should my sector composition be?
So we prefer financials on that, like I said, because there is a high confidence of even, let's say, subdued growth relative to history, and I'm getting these stocks at a much better valuations relative to what financials are trading elsewhere in the world. We like the consumer space, and we've talked a lot about it so far, because there is enough of a stimulus. A couple of sectors we like on the side is we like real estate, we like power, we like the defense stocks. So we have those idiosyncratic bottom-up picks as well. But on a core basis of financial stroke consumer discretionary makes a lot of sense.
Sanjay, a lot of new money has not come into the secondary market, but new paper which is coming, whether it's IPO, whether it's block deals or PE exits, everything. Do you see this trend to continue in this year as well?
Must, because that is the function of market.
Because that's not bringing in the momentum in the secondary market. It's just absorbing the liquidity, and then, the momentum that needs to...
We don't need momentum. Why should we? It is not an imperative, right? The function of the equity market is to take savings and provide it to corporates who will use those savings to grow assets, right? And the equity market is discharging its function because there is money coming into mutual funds or through retail, and it is being transferred to corporates through all these listings and IPOs. Now, some of it is our exits, but again, that's recycling of capital. So what is happening is exactly what the market is designed to do. And as long as there is supply of money, there will be a demand of money. The market has to balance out.
And the secondary market function where trading, where the FI volumes come in the secondary market as a trading volume, that's something which is much lower today compared to maybe a year or two back, right? In that sense.
See, again, if you step back, and again, we return research on this. On a daily basis, the net flows are zero, right? There's as many buyers as many sellers, right? Why does the market go up or down? It's on the impulse of the buyer. If the buyer is more aggressive, the market goes up. If the seller is more aggressive, the market goes down. So I think a lot or too much of an excessive focus is put on this flow analysis. If I may be a bit harsh, that's like chasing your tail, right? We cannot invest on the anticipation of flows. We have to invest slightly more fundamentally. And like I said, India it's much better in the context of where global equities are today.
And how does it change your coverage platform? Because MSCI India, few years back had 80 stocks, now 160 stocks. The expansion of stocks which are coming in, foreigners now looking at more alpha in many new stocks which is there. How does it change as a brokerage, how do you look at that actually?
Well, thank you for the question. It gives me an opportunity to plug myself a little bit, right? Because JPMorgan has invested a lot in its equity franchise in India. A few years ago, we were covering somewhere around 125 over 30 stocks. I am within short of being 190 stocks now, because the impulse is right. The market is growing. The expansion of liquidity is durable. It's here to stay. And it is imperative upon me as a brokerage to stay competitive. We are, if I remember my number right, a top 3 foreign broking house in terms of stocks covered now. And there is a clear emphasis from all the senior management at JPMorgan to continue to stay invested in India, to grow our investments and increase our footprints in the economy.
Mm-hmm. And India will always be a stock picker's market anyway, right?
Yes. Again, to be very harsh, India used to trade 3 billion a day in 2019. Even though the market's soft now, I'm still trading 12 billion a day. There's 200 odd stocks which have F&O, a lot of liquidity, a lot of hedge fund interest. So things have structurally changed. The economy will go up, it will go down, the markets will be flat and then not flat. But there is a structural change in the size of the equity market, and it is imperative for us as participants to respond to it.
But for this fiscal year, you're expecting new highs, right? Better than the previous high.
Logically, it should go up every year, to be honest. Our target is 26,500.
And over the next 12 months?
Next 6 to 9 months.
And you will have short-term peaks coming in, volatility? Because you have a couple of events coming in, India, US trade and others, there's other resolutions that comes in. Is that going to bring in some kind of, impulse into the market, as you say?
I do think markets tend to be mean reverting. So the premise might prove to be correct, but again, it's impossible to be precise.
Okay, Sanjay, on that note, we'll let you go. Thanks for your time. Thank you.
Great being here. Thank you.
We have with us right now Jahangir Aziz to talk about what the state of the economy, not just for India, but for the world is looking like. Jahangir, welcome to ET Now. Good to meet you in person.
Thank you.
What's the world view right now? And let's start off with the US. Where is this tariff war going to head?
Look, so I think there is a sense in the market that with all of these trade deals, let's leave India aside for the time being. With all of the trade deals, there is a sense that the tariff or the trade war is settled. I think it's far from settled. So if you look at the tariffs, almost all the tariffs were used using the IEEPA Act, International Economic, I forgot what IEEPA stands for. That's what the reciprocal tariffs were. That's what fentanyl tariffs were. And we have been tracking this a while, saying that there are major legal challenges to it. We had one challenge that was heard by the U.S. Court of International Trade that ruled that the IEEPA tariffs were illegal. That went to the U.S. District Federal Court that upheld the lower court ruling. And now it's up to the Supreme Court. The Supreme Court is going to hear it in the first week in November. It hasn't said when it will hear. But if the Supreme Court also opposes the lower court rulings, then all of a sudden the basis of most of the tariffs, not all, most of the tariffs on all of these countries essentially is invalid. And then so are the trade deals. And then we go back to the drawing board saying that what are the alternative, and the U.S. has alternative ways of reimposing the tariffs, but those ways, those avenues that they have, the nature of the tariffs will be different, the countries will be different, quantum will be different, and the sectors will be different.
But assuming that there would be tariffs in whatever form or quantum or whatever, are we looking at slower global growth in the times to come?
Yes, and I think that what has happened over the last, I would say, 3 quarters, since the tariff concern started, which was back in November last year, I think that is essentially is being camouflaged, that slowdown is being camouflaged by several things. One is the reaction by U.S. corporates to front-load imports, which had a massive impact on the rest of the world, particularly in North Asia. So that was the first thing. The second thing is that the slowness with which the tariff increases are being passed on to inflation is because, again, U.S. corporates are absorbing most of the tariff increases on their balance sheet right now, on their profit margins. There are obviously clear limits to how much you can absorb on your profit margin. Sooner or later, that will get passed on to consumers. We expect that to happen in the 4th quarter. So there you are going to see a spike in inflation. And from there on to consumption in the U.S. on the labor market itself. The labor market itself is softening. And the third bit, which is where I think most of the camouflaging is that alongside all of this tariff wars, completely independent of the business cycle, is the tech cycle. The tech cycle has nothing to do with the business cycle, right? And the tech cycle has been enormously powerful. U.S. capital equipment grew in the first half by 15.5%. Almost all of it was tech equipment. You can look at the S&P 500, how much of the tech companies is driving it. And as a result, you have to sort of pass out all of these 3 factors. And the big call is that how long will this tech cycle last? We know that it's not related to the cycle, but how long will it last? So I think there are these 3 things that drive that wedge that, growth has been very strong globally, at least stronger than expected. Yeah. But just because it hasn't happened, doesn't mean it won't happen.
Never will.
Yeah, the entire premises has been the huge deficit that U.S. is running with respect to trade. And this tariff has been to get that deficit lowered.
Yes.
What is the kind of impact that you see for the U.S. as a whole? There are some figures of $300 billion of additional revenues coming for the U.S. Do you think that it's going to help in some way to bring down that huge deficit?
No, so the deficit, what happens to the trade deficit and what happens to the tariff, this thing, etc., are 2 separate things, right? So there are different ways of looking at it, right? One way of looking at it is to say that whatever the trade deficit or current account deficit is, that's just what U.S. needs to borrow from the outside world to meet its fiscal deficit, given what is happening to domestic savings, right? So if you have fiscal deficit going up, it's not going to go up to 7% if you believe that all of the $400-500 billion of tariff revenue is going to come, but it's going to go up from around 6% to about 6.5%. So you have a 0.5% increase in fiscal deficit in the U.S. Who's going to fund that? In the last 8 years, no one really ever was concerned about it because it was a reserve currency. If fiscal deficit goes up, it's going to be funded by foreign borrowing, which means that the current account deficit is going to widen. But now you have an administration that is targeting that too, as you rightly pointed out, with the tariffs. So whether or not the trade deficit widens or narrows depends entirely on who is going to fund that 0.5 percentage point of higher fiscal deficit. If the domestics are willing to fund that through higher savings, then current account deficit can actually fall. But if the domestics are funding that with higher savings, then either consumption or investment or both need to slow. That's the only way you do get higher savings, which means growth rate in the U.S. is going to slow down. So there is no such thing as a free lunch.
What happens in India's case? Because kind of the same story playing out. While consumption is getting that fillip, you've got the RBI backing it, government, etc. as well, trying to propel growth into the economy. But then what happens to capex?
So, look, we've been crying about capex and, hankering about capex since 2012. Yeah. Corporate investment as a share of GDP has been flatlining since 2012 at 12%. At some point in time, we have to give up this thing that, this is cyclical reasons. It's because of, GST was imposed. It was because the banking sector was weak. Now the banking sector is back. It's because of this, that, and the other. You can't have corporate investment flatlining at 12% at 13 years and then say, this is not structural. It's a structural story. It has very little to do with cycles. I know we want to believe in green shoots and cycles and every pop-up does half full thing. 13 years we've been talking about it, right? At some point in time, we need to step back and say, look, there's something structural about India's corporate sector. And that's where I think the debate has not been there. It's always been focused in India on what are the cyclical factors, what is the proximate cause, and we've always blamed, now we're going to blame tariffs and external headwinds. Previously, we blamed the banking sector. Before that, we blamed the introduction of GST. I think we're running out of excuses. We need to really actually find alternative engines of growth. And the corporate sector is, flatlining at 12% is because there are no alternative. We haven't identified alternative sources of growth.
So what is the solution?
The solution is that we basically go back and figure out what has been the reason as to why we had this massive increase in corporate investment back in the period 2002-ish to about 2008-9. We had the global financial crisis. Why did it actually fall in the global financial crisis, and why has never really picked up? It has to do with the corporate India not fully buying into the domestic-driven or the export sector-driven story. They have to buy into that idea. They haven't. I mean, that's the only obvious explanation I can come up with.
What about a domestic story? Because you have consumption in domestic, and that's, if you look at India as a whole, we are not so much dependent on exports, but we have a good domestic story which is going on.
So and you take investment either in growth rate, overall investment, or as a share of GDP, then take exports growth rate or exports as share of GDP, draw the two lines, there is no daylight between the two of them. We are an exceedingly open economy. We just do not want to actually acknowledge that. And I think that is one of the, in answer to your question, that is one of the first acknowledgements we have to do. Literally, take investment as a share of GDP, take exports as a share of GDP, basically there is no daylight.
Jahangir, we could go on chatting about the world, but thank you so much for your time. I believe you have to get going.
I have to get going, and thanks so much
Thank you
for
so
coming
much.
to our conference.
Thank you.